Clients keep asking us when this cycle is going to end, by which they mean when it's going to roll over, because the cycle, of course, never ends. But the upcycle will end, and we've tended not to take a view on this until recently because the medium-term prospects are reasonably good, and better, in fact, than they've been all this century. But finally, things have been beginning to develop in a way that could cause an end to this cycle, although almost certainly not until next year. And the things that are beginning to point towards an end of the cycle are essentially related to foreign exchange rates, in particular the strength of the euro and the weakness of the dollar. On the euro side of things, the Eurozone has a current account surplus of not far short of $500 billion, and there's a very large surplus too in Sweden, Switzerland and Denmark, and the euro is tending to go up. So much so that if ECB policy remains easy, then the Eurozone will continue to overheat and to grow well above trend rate, and therefore cause the euro to be strong. Alternatively, of course, if the ECB starts to reduce its stimulus, then that in any case is going to be associated with a strong euro. So you get basically a strong euro on either scenario, largely because with a very large current account surplus, the currency will go up unless there are very good reasons for capital to fly from the Eurozone, which we don't think there are. So that's that, and the effect of that, of course, is that ultimately a big rise in the euro is likely to slow Germany and to hurt Italy, and that is how the Eurozone end of cycle is likely to occur, but as I said, not until at least the middle of next year. On the other side of the Atlantic, of course, you have the opposite story in a sense, but again, it's a reversal of cause and effect. Until recently, we've always been assuming that a strong interest rate development in the United States will cause the dollar to be strong. And therefore, people have said that the dollar will be helped by the Fed's reduction of stimulus and by the upswing of 10-year bond yields. But what actually has happened is that the dollar has become weak because, first of all, it is above its long-term average in real competitiveness terms, but it is in any case weak not just against the euro, but against the yen, against the Canadian dollar, and even to a limited extent the Chinese yuan, against which there's been a big move over the last year. And so on a trade-weighted basis, the US dollar is going down. Now, at the same time, we have, of course, an increased budget deficit in the United States that needs to be financed. And that means that with a weak dollar on people's minds, interest rates will have to go up in order to finance the trade deficit and particularly the budget deficit. So you've reversed engines here. Instead of strong interest rates causing a strong dollar, we're in a position where the weak dollar is the driver, and it causes an increase of interest rates. And it's that interest rate increase which sometime around the middle of next year is likely to pass over from a response to the rapid growth of the economy to a level at which it will actually slow down the economy and cause the end of this upcycle.